Good afternoon and welcome to Biztech's Asian Midday Market Watch, powered by Rajhi Bank, Malaysia. Jeffrey Halley, Senior Market Analyst, Asia Pacific at Oanda, is our guest today. Jeff, thanks for coming in.
Always a pleasure, Brian.
Now, we're going to take a quick look at crypto markets first and then regional stock markets, and then we'll come back to you. Bitcoin is at 31,701.2. It's up 4.41%. Ethereum is at 1,987.91. It's up 6.01%. Now, looking across the regional stock markets, the SGX is up 0.41%. KLSC is down 0.1%. Shanghai is up 0.89%. The ASX All Ordinaries is down 0.42%. The Nikkei is down 0.21%. The Hang Seng is up 0.76%. And rounding up the numbers, we've got the Kospi, which is up 0.36%. Now, so a very mixed market today, Jeff. What's the reason for that?
Yeah, markets are drifting a little bit today because we had a US holiday overnight, so those OTC markets were closed. So we don't have a regional indicator for markets to sink their teeth into. I think we're seeing a little bit of long covering after European yields moved higher overnight after that huge German inflation number, and some quite hawkish comments from Christine Lagarde and the head economist Philip Lane there regarding interest rate increases and unwinding quantitative easing. This morning we've seen a recovery in China PMIs. They're still contractionary, but much less so, and we've also had some news that Shanghai is unwinding some of more of their restrictions. That's seen Chinese equities up by around about 1% today. But the rise in US yield futures, rise in US yields this morning, and those yields overnight in Europe is just weighing on equity futures. I think also we're seeing oil rise yet again this morning after that EU ban on Russian oil was announced. And that's also weighing on sentiment in Asia today as well.
Now, Jeff, I want to ask you, because obviously that German inflationary number then puts the spotlight on the ECB meeting that's upcoming.
Yeah, look, the June meeting is, I think, in 10 days, and I don't think we're going to get a rate move then. We have to remember that effectively Europe is in a war economy with the conflict they have on their eastern border. So that complicates all of the work that the ECB may be wanting to do. There's obviously cost of living and pressures in Europe. There's not much the ECB can do about that with monetary policy. But overnight, Ms. Lagarde and Mr. Lane did say that 2.25 hikes and a by September, and an unwinding completely or a halting of their quantitative easing program was on the cards. And that's why we saw European yields rise overnight. Interestingly, the euro didn't get much of a tailwind off it, not like the US does when it hikes rates or is about to hike rates. So I think maybe the euro rally is running out of steam at these levels.
Now, Jeff, the other thing that's also caught my eye was the fact that when quantitative easing was mentioned in Europe, the conversations in the media have sort of downplayed, or in fact, the conversation has dropped off completely in terms of the Fed's quantitative easing. What are your thoughts on this?
Yeah, it's one thing I think the markets really are missing. There's two things that the market are just ignoring at the moment at their peril, I believe. One of them is the rise in oil prices. Brent crude is now $122 a barrel, 123, I think, this morning. The second one is the start of quantitative tightening by the Federal Reserve. This week, they start unwinding that $8.5 trillion balance sheet that they've accumulated over the pandemic, across the financial crisis, etc. It will also be a double tightening, raising interest rate by 0.5% a few meetings, and scaling up sales to hit nearly 100 billion a month by September as well. Interesting to see how the market absorbs that quite impressive amount of monetary policy tightening. And that's why I think equity markets in particular, which are desperately looking for a turn in the cycle, are actually trading at their peril at the moment. We've got quite a few obstacles to come, let alone all the inflationary pressures that are still to move through the world.
And I must apologize, I meant tightening, not easing. But on a different note, one thing that is catching analysts' attention now, and with rising concern over the funding gap that exists in China as a result of the lower revenues that they've been receiving out of land sales and tax refunds and so forth. Now, that gap is estimated to be as much as $1 trillion US. And that's something that they've got to go out and basically take on more debt. What's your view on this, and how is that going to impact the Chinese economy?
Well, I guess it depends on whether it's $1 trillion worth of yuan or not. And these numbers are quite opaque when it comes to China anyway. But I mean, if the central government is competing for capital in the bond market along with borrowers, then that would be normally quite a challenge for interest rates. But in this case, economic activity has fallen dramatically in China, and the big Chinese banks are sitting on bucket loads of cash that they can't lend out to anybody. Also, household savings are very, very high. So although, yes, that's a big number, I think it's entirely fundable, if that's actually a word. And it's not really a story at this stage. And I think if it was a story, then we would have seen Chinese equities on the mainland particularly head lower today. But instead, it's clear that the Shanghai and Beijing reopenings and the increase in economic activity is what's driving markets. So I don't think we need to be hitting the panic button just yet.
Now, Jeff, thanks for taking the time to speak to us.
Always a pleasure.
We've been speaking to Jeffrey Halley, Senior Market Analyst, Asia Pacific at Oanda, on Biztech's Asian Midday Market Watch, powered by Rajhi Bank, Malaysia. I'm Brian Fernandez. This video and podcast will be on our website, www.biztech.asia, as well as Rajhi Bank's social media platforms. Please subscribe and like our various platforms. Thanks again for tuning in.